If you're new to this channel, this is where we talk about property investing, share smart investing strategies, and anything property related. So if you haven't already, make sure you hit subscribe, smash that like button. All right, now let's get into today's question. So for today's content, I'm going to take you through a bit of a case study of ours, called Mark's Journey. And it's really a common scenario that we come across kind of on a daily basis here at the Ripehouse business. And I guess to give you a bit of a summary about Mark, he's like the everyday Aussie. He's worked hard, he's paid extra on his home loan and feels confident he'll pay it off over the next 20 to 25 years. So far, so good. Until he starts to take kind of a closer look at his retirement picture. You know, his superannuation is projected to hit about $1 million. And that's by the time he's 60. And it's a decent sum, but when Mark starts crunching the numbers, he kind of quickly realizes that that might not be enough to, fund the lifestyle he wants, that in terms of holidays, helping the kids, not worrying about the day-to-day. That's kind of this summary here, 40 years old, married with kids, bought a home 10 years ago for $750, now worth about 1.5, mortgage of $450. When we start to, kind of break down the challenges he's going to face along the way, it's that $1 million won't really get him far through retirement, right? Particularly when you want to factor in holidays, supporting kids, financial freedom. And it's also too, you need to have almost like an income when you get into retirement. It's all well and good having that lump sum at the end. But if you go through all that money, there's nothing else to continue to sustain the lifestyle. So in terms of what to do, Mark needs to really look at creating an income for himself outside of super, coming into an income stream to help him work without working into his 70s, because no one really wants to be working into their 70s. So what does Mark need to do? So the property portfolio strategy is really kind of 5 things. He needs to leverage the equity in his home. He needs to buy 5 quality investment properties, and that doesn't mean all at the start, and I'll walk you through that as well. He needs to hold those properties for 10 to 20 years. The big one, he needs to let growth and compounding do its thing and then sell down for retirement. So I guess to walk you through what that looks like. So in Mark's situation here, we've got him buying 5 properties over essentially an 11-year period. So he buys 1 in year 1. Again, we've used full equity. So we bought a $500,000 property at $525,000 of a loan. We're going to sell it in 20 years' time, and we're going to we'll sell it for about just under $2 million. We're likely to walk away with about $1 million in cash, give or take, after selling costs. In year 2, we're going to buy our second $500,000 property. We're going to repeat that same process. In this instance, we're going to walk away with about $900 to $950. In year 4, we're going to add our third property in, and because we're holding that for a less amount of time now, we're not going to hold it from years 1 to year 20, from year 4 to year 20. We're going to sell it for about $1.6 million, and we're going to walk away with about $750. For property 4, we're going to buy that in year 7, again at $500,000. It only gets up to $1.3 million in this instance. We're going to walk away with about $550 or so post-sale. And then in year 11 is when we buy our last investment. So we sell that for just under $1 million, and we walk away with about $320 or so after the sale process. Now, I should preface here as well, we would probably be pretty strategic along the way in terms of how and when we sell these. It might not necessarily always be at that timeline. Might be better off staggering the sale, but this is just more to give a bit of insight in terms of what it could look like. But after that sale process, Mark has over $3.5 million worth of cash post that 20 years, which means in combination with his super, as well as the $3.5 million of cash that he walks away with, Mark's able to enjoy at a 6% net return a passive income of over $250,000. So that's kind of how powerful it can really be. And I guess the lessons and the takeaways we want to take away from that is you don't need 20 properties. Equity in your home is also really powerful. I guess where a lot of people don't understand is that you don't need a 20% cash deposit sitting in your bank account to go and buy a property. You can leverage the equity in your home to go out and fund and start your investing journey. The third one's really important. You need to let time do your work. We can't be making this 20-year plan work in a 2-year period. Otherwise, you're going to have to be hyper aggressive, and you're going to need to have a lot more capital behind you. Also, I guess understanding the sooner you can be aware that your super alone isn't going to fund your retirement for you. I think for a lot of people, they leave that too late in their piece, And again, we're trying to turn a 20-year plan into a 2-year plan. It's just not going to work. And learning how to turn equity into income, because everybody wants to grow their wealth, and that capital there, equity sitting in the investment properties, is not going to replace our income as well. So there's also a way we exit those markets later on to be able to replace the income stream. So I think the key considerations somebody needs to make when they're getting down this pathway is, firstly, is the correct structuring taking place? Because that's really key. And like I said, what we haven't talked about in this video today, when you're going down this pathway, you're going to be talking with accountants, brokers, financial planners, etc. It's going to be really, really strategic layers that we can add on top of this to make it even better. But you've also got to maintain your discipline and understand the borrowing capacities as well along the way. We can't all go out there and buy 10, 20 properties off the bat, but coming with really kind of, realistic timelines and timeframes. I guess what we didn't show here is we weren't saying you need to buy 5 properties at year 1 or year 0. We're going to buy 5 properties over an 11-year period. And the reality is, those properties start to turn cash flow positive, potentially. They also start potentially you're paying off some of the debt depending on your cash flow position as well. So there's all these different changes. And, knowing your cash flow implications, because servicing multiple properties as well is something to always be considered. But you've got to really make sure you're buying well. That's a big mistake a lot of people make, is they don't buy well. If you forego a lot of your growth just from buying lazily at the beginning, it kind of really set you back on your journey. But the biggest one, and I've mentioned it a few times in this video already, is just getting started now, because you need time on your side to make your financial goals work. You can't, you go to really high-end restaurants. I'm a big American barbecue enthusiast at heart, and the best cuts of meat, they're slow cooked over a long period of time. You put that same cut of meat, you give it a 1-minute sizzle on each side, you'll be chewing on it for the next 30 minutes. So you need time to really leverage and compound and get these assets to grow. That's what's going to get you to the desired outcome. But I hope everybody watching took some advice out of this one, got some, key insights. If you like this one, make sure you hit subscribe and hit that like button, and we will catch you on the next one. Bye for now.